Hi, everybody, and welcome to the Pay Tax Once Nation. Today, I'd like to share with you my journey and what my clients learned on the road to retirement. When people ask me what I do, my usual response to them is obviously, thank you for asking, but why I do what I do is far more significant than what I do. So, in the next few minutes, I'm going to share with you a little snippet of my story of why I do what I do. I don't have any graphs or graphics or charts to show you. So if you're driving, working out, or on a nice walk, all you have to do is just listen to this recording, especially for those of you who don't trust banks, Wall Street, or government. So picture this. You're 5 to 7 years away from retirement, and you realize that you can't even calculate your retirement income because you have no clue what future tax rates will be. It's like trying to plan a road trip without knowing the price of gas. Then you find out that when you start drawing money from your 401k or IRA, you could be fifth in line to get paid. That's right. There could be 3 or 4 other entities that get their cut before you even see a penny of your net retirement check. And to top it off, your financial advisor is pocketing 15, 20% of your annual retirement income before taxes. Nothing wrong with that. They do get or want to get paid, but it's still part of the reality. So suddenly you discover that your required minimum distribution percentage exceeds the safe withdrawal rate that your advisor has been recommending, the one that was supposed to give you a 93% chance of not running out of money. Ouch. And the fees you're paying also are being paid on the money that you owe to the IRS, or if you have a state tax, your state treasury. Could be income tax, could be capital gains, but it's still a tax. And just when you think it can't get any worse, you learn that up to 85% of your Social Security benefits could be taxed. As if that's not enough, you might have to shell out extra money for Medicare premiums, sometimes 2 to 3 times the minimum amount. So if you have to take out money to pay your Social Security tax, you're now exceeding the safe withdrawal rate used in the industry. So let's go back 17 years ago. I entered the financial service industry because I was bored out of my mind in the loan origination business that I had built. I'd built 2 companies. Many of my successful clients had outgrown the financial advice they were following, advice that was not only outdated, but it also set them up for major disappointment. They didn't realize the full implications of the financial decisions that they had already made. I soon saw the light after meeting with an advisor who shared my skepticism of conventional mainstream planning. Traditional planning, to me, was stuck back in the 70s. It hadn't even evolved alongside our ever-changing world. Back then, it was, close to 1996. While everything in life had changed over that period of time, it seemed that financial planning was all the same. Someone wiser than me challenged my thinking on that. They asked me what I truly wanted instead of what I thought I needed. So going back even further, as a successful account manager at a Fortune 500 company, this is before I became self-employed, I started questioning my own 401k at the kitchen table with a calculator and some notes. Basic calculations showed me that no matter how much I deferred pre-tax, I would certainly not be able to sustain my desired retirement lifestyle. Worse, I realized I might not retire in a lower tax bracket because future income taxes were unpredictable. Not only was I deferring income into those plans, but I was also postponing the taxes. And I even asked my CPA, hey, would you mind writing a letter on your letterhead and signing it and dating it, guaranteeing me that I will retire in a lower tax bracket? He refused to do so, and rightfully so. So at 30-something, with no internet or social media, I just followed the herd, only to later find out that everyone wasn't doing the same thing. Everyone wasn't just investing in a 401k or an IRA. There were other things that people were investing in to create a retirement nest egg. I also learned that there was a second playbook being used, a different playbook that was being taught on Main Street by Wall Street institutions and banks. I also discovered the various credentials used by financial services professionals and how they influence the type of advice given to the public. Before this discovery, maybe even like you, I thought all financial service professionals were the same and offered the same type and level of service. That turned out not to be true. Just like my retirement funds, what I thought to be true about that didn't turn out to be true. To sum up my analysis, I realized I had pre-tax contributions going in tax deferred, but I'd face income taxes upon withdrawal during retirement. And if I needed the money early, I'd be subject to a huge penalty. The longer I held this account, the worse the account could be. It was like taking a loan without knowing the interest rate or payment terms, or even taking a road trip without knowing the price of gas and lodging. It gets worse. I realized I was paying fees on money that I would eventually have to pay to the IRS and the state treasury. That didn't make sense. I'm the one taking 100% of the risk. I'm doing 100% of the funding. I'm paying 100% of the fees. Not only the money I'm going to use, but the money I got to use to pay Uncle Sam. That did not set good with me. Dad, insult to injury, my advisor pointed out that I was merely a beneficiary, not the owner of a 401k or an IRA. That was a big wake-up call. At that moment, I realized not only do I have 2 to 3 partners involved in my retirement, partners that didn't take any risk, didn't offer any value. All they had was their handout, waiting for their cut. But I realized I did not own the account. So my distrust of the federal government kind of went up a few notches at that point. Again, this was a long time ago. We didn't have the access to information we have today, but it was interesting and compelling of what I learned. So fast forward, life is starting to get better. I had a meeting with a new financial advisor who taught me more about wealth accumulation and wealth distribution. In 1 hour, he taught me more than what I had learned in the last 15 years. I learned that our financial knowledge heavily depends on our circle of influence, our life stage, and opinions from others passed down by generations, as well as information being disseminated through the media. Everybody knows that, but you kind of get locked into that loop. So a few meetings later, my advisor set me up with an after-tax funding strategy for retirement. And this was the nucleus of my Pay Tax Once YouTube channel and website, way before it was even an idea. The strategy allows me to contribute after-tax dollars, again, pay tax once, put them into an account where the money can grow tax-deferred and withdraw or take a loan against myself, 100% tax-free. No 1099, no W-2, nothing to even put on my tax return. To me, this was quite revolutionary. And then I learned that a lot of other people were using this strategy. And I was just finding out. That kind of bugged me. That advisor eventually recruited me into the business when I got bored to tears with the loan origination business. Now, I did work with his firm for 4 to 5 years, spreading the word about this tax-exempt strategy, used by banks, Wall Street, and many of my peers. Again, that's that second playbook I mentioned here a few minutes ago. Interesting enough, I soon discovered that the firm's approach to doing this was flawed. They were teaching us to make clients feel wrong and then convince them to follow and implement our strategy. To me, it wasn't a sustainable, nor was it in the best interest of my clients because it's not a fit for everybody. So I eventually left the firm and joined another firm just to kind of clear the noise, take some time to figure out who my ideal client really is and how I can deliver life-changing value to them when it comes to accumulating wealth and retirement planning. At about the same time, I made a change in my planning approach because many of my clients started coming to me and asking me for advice with an emphasis on retirement distribution planning. In other words, they're at that point in life to where, hey, we need to start thinking about what this money is going to look like when we go to use it. So they needed that education to transition them from accumulation to distribution and providing reliable and predictable income through their retirement. I realized that my industry education had focused solely on accumulating, protecting, and growing of assets, not a single word on distribution planning, and that seemed profoundly contradicting in a fiduciary role. So why is my industry not teaching me about retirement distribution? Why is my industry not teaching me about the implications of the decisions my clients have already made? So again, that second playbook is starting to get even louder and bigger in the back of my mind. Why are banks and Wall Street institution, business owners and entrepreneurs not fond of traditional mainstream financial planning, but yet they preach it? Why is it that many of them don't trust Wall Street, advisors, or even government? Why is it that these institutions teach people on Main Street out of one playbook while they use another playbook to build, accumulate, and distribute wealth? So soon enough, I attended a workshop in regards to a new planning software that a gentleman on the East Coast created. It was designed to actually practice in distribution planning, how to take your clients' assets and set them up to receive an income for the rest of their life in retirement. I mastered it, and it truly added value to my practice, and my revenues grew exponentially. But I soon realized at the time that most of the plans out of that were putting people on a track for income for life, but taxable income for life. In other words, they would have to pay unnecessary taxes forever, again, into perpetuity. That is not the pay tax once mindset. Clients with Roth accounts had too little to make a difference in their income, and many of them did not qualify to put money in Roths. They either made too much money or they made too much money. That's kind of how it goes when you become successful. You end up making too much money, and now you can't even put money in a Roth account. It didn't matter to them because the contributions that you're allowed to put in Roths were minuscule, not even enough to make a difference. But it was also this workshop where I learned Social Security benefits could be taxed and Medicare premiums could increase based on retirement income thresholds. This was a rude awakening. I looking at my clients facing a 3.5% safe withdrawal rate, taxed Social Security benefits, increase in Medicare premiums, and unpredictable future income tax rates, all leading to a big problem. Less money to them and no certainty of reliable income during their retirement years. Not to mention being forced out to take withdrawals from these plans at age 70 and a half. Back then it was 70 and a half, now it's 72. And that was whether they needed the money or not. But what happens if the government increased the tax rates at the same time? So now if the government increases tax rates, then that's less income that year for that client. So again, problems on top of problems on top of problems. But I did ask myself, how can these plans be such a great deal? They're not, in my opinion. So despite these challenges, my business did thrive in specializing in the distribution planning arena. But I needed solutions for the uncertainty of income taxes and what to do and how to help clients, especially those that didn't trust the market, didn't trust the government. I get it. They're entrepreneurs, they're independent thinkers. They have worked hard for their money, and they feel they should be entitled. They feel they should be able to keep as much of it as they wanted. And I totally agree with that 100%. So the answer was in plain sight, but for some reason I'd become blind to it, kind of lackadaisical. But a colleague of mine invited me to a boot camp put on by an industry expert, a game-changing expert, in my opinion, in the pay tax once arena. Teaching your clients how to pay tax once, put their money in a vehicle, and they never have to pay taxes again if they do it right. And it's not hard to do it right. It's easy as first grade. But in that, because in the other firm, I learned to make people wrong and try to convince them, in this workshop, they suggested, why not just look for people that believe in what you believe in? They believe that traditional planning is somewhat outdated or obsolete. They don't believe in trusting other entities when it comes to their money. I totally agree with that 100%. Look for people that don't, for example, trust Wall Street, banks, the government, or the one-trick pony advisor. But also identify those independent thinkers, the business owners, the entrepreneurs that are high achievers, the guys that started from scratch, the gals that started from scratch, that have eventually and over time, they've created a very nice running, solid business. Those are the people that I totally relate to much differently than I do someone who's working for a company. Although there are exceptions. I do have W-2 employees using this strategy. So in the end, during that one-day workshop, I learned more about the implications of wealth accumulation and distribution in that one day than I did in the previous 10 years. It just simply brought back what I learned 15 years ago when I first entered this business, just in a different way, using a different tool, way different tool than previous. So I'm going to wrap up this conversation with you, but just with a few key points that I picked up along the way. A couple of things I want to share with you. couple aha moments I had. One is, where your money lives. In other words, where your money lives is more important than what it earns. I learned that the tax-exempt pay tax once strategy delivers 40 to 90% more money in retirement than traditional planning. 40 to 90%. That's big. And it's all yours. You get to keep all of it. I also realized, through basic sixth grade math, you would need 2 times the amount of money in a taxable investment to get the same amount of money from the pay tax once strategy. That's crazy. What if someone doesn't have time to have 2 times as much? And then the biggie, I learned I could be paid 5th in line when taking distributions from a qualified plan. My clients started figuring this out. They're like, I'm taking money out, but now I got to take money out to pay the taxes, and I got to take money out to pay the taxes on my Social Security, and I got to take more money out to pay the additional monies on my Medicare premiums. That was crazy. I've seen Medicare premiums as high as $489 each. Husband, wife, each. That's each. Do the math. That's incredibly crazy. So that's all I have for you today. I hope you picked up a few tidbits here that have either inspired you or even motivated you to do something about your situation. If you liked what you heard, please feel free to subscribe to my YouTube channel. Also below, there's a couple of links. One's for a quick webinar that goes into the details of the pay tax once strategy. And I've even written an ebook for you. If you prefer reading, go ahead and download the ebook. That's all free of charge to you. Meantime, thank you very much for your time today. Have a great day, and I appreciate you. Bye-bye.